I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. How are you doing?
Well, we're doing great in Vancouver. Sunny skies, the ski hills are packed with lots of snow, and for us, that's a good thing.
I hear that. Well, here in the United States, it's cold in some parts of the country, and but the stock market seems to be kind of frozen for people because it's not really moving much. The Dow went above 20,000 the other week, and as of the second, it's below it. But it had been pausing for weeks before it went above 20,000. In fact, the Dow had been in the narrowest intraday range for that amount of time, going back to 1964. Usually that leads to a giant move, and instead it just went above 20,000 for a couple of days, and no volume came in the market or anything, and it kind of petered out. So that seems to be the story of the stock market, not much movement, but other stuff's going on in other markets.
When something like the Dow hits a record high, is that actually a warning to investors that perhaps things have got as good as it's going to get?
Well, in some sense, I think there's a good argument for that, and that is the number of 20,000 of the Dow in itself isn't really that important. However, other indicators, I do think, show that the stock market is very overvalued on a historical standpoint. The cyclically adjusted P/E ratio, for instance, is higher now than it was in 2007. Before that, it had only been that high two previous times. The price-to-sales ratio for the S&P 500 is practically at an all-time high. Now, that's just that the gains to the stock market are fairly limited from here. That in all in itself, though, doesn't mean the market's going to crash overnight or anything. But it means that from an investment standpoint, it is the best investment in the world to be making right now. If you want to trade it, that's one other thing. But even the trading is different now than it was years before, because so far this year the volatility is super low, the intraday movements are super low. So that can be tough. And I think a lot of people I get emails from are trying to find niche sectors to trade that have more movement to them. For instance, marijuana stocks shot up last year into the election. They haven't made new highs since then, but that move has excited lots of people to try to chase them. These are basically micro-cap stocks, and I see promotions for them all over the internet, in fact. Uranium stocks had a recent move, too. But these are very tiny niche sectors in the uranium world. There's really only two major companies that are producers, and the rest of them are exploration stocks. So it's not like it's a really big sector that takes a lot to move it. It's already shot up so much. So I'm more the mind of trying to find out what are going to be the big trends that aren't just going to last a couple of weeks, that could be meaningful for years. And to figure that out, I think the number one trend, if I could say there's one thing that could impact lots of things, is the bond market. Since about 1980, we've been used to essentially a bull market in bonds in the United States, but also all over the world. That bull market meant very low interest rates. Last year, we even saw interest rates for European debt, such as in Germany, reach negative yields as the central banks over there engaged in a massive money printing operation, another round of quantitative easing that they boosted up and the market fell in January and February to try to make everything go up. That's how the central banks over the past couple of years have manipulated the markets. It isn't by buying, every day or something, but by buying bonds and pushing yields to super low levels. And what that enables to happen is companies to issue debt, borrow money, and then buy shares themselves off the market. And one interesting thing is that we spoke around late July, and I made note that the buybacks were fading out, that companies were announcing they were paring them back, or they weren't announcing them at the same rate as they had in the past. And that looked like that could be a troubling thing for the stock market. But after the Trump election, companies started to come out and say, oh, we're going to actually boost the buybacks now because, Trump's going to lower taxes or allow us to bring money back to the United States, and we'll use some of that money to buy back the shares. And there's a report in the Wall Street Journal in December saying that they expected buybacks to be increased by a third from where they were in the 12 months prior to that, year over year. So that provides buying in the stock market in a market, though, that is super overvalued. And at the same time that is super overvalued, insider selling is very large. There's a recent update I saw where the ratio of insider buys to sells is 6-to-1 recently. That can fluctuate week to week. So you have this strange recipe when it comes to the stock market of high valuations, but buybacks that can prop things up, but the high valuations make the gains very limited. So I think that's the story of the stock market. But the key, though, of the trend that can change is this bond market, because I believe we saw a secular top in the global bond market last year when the interest rates went negative in Europe. And ever since then, slowly, interest rates have creeped higher across the world, most dramatically, though, in the United States, especially following the election of Donald Trump. Now, as we're doing this interview, the Fed just met, and they projected they didn't raise rates today, but they're projecting 3 rate hikes for the rest of the year, following one they just did in December. So they're on a heightening cycle, and Trump's economic team has made statements that they would like to see higher rates, that they don't believe zero rates and QE stimulates the real economy no matter what it may do for the stock market. So what this means is that bonds are set up to be in a bear market, or at least not have any good upside to them. I don't think they're going to crash overnight, but if bonds aren't going to go up like they have for the past since 30 years, they're no longer good investments for people. And that has lots of ramifications. In the past, really, just about everyone listening who's been investing in the markets, they have been used to an environment in which whenever the stock market dips, money goes out of the market into bonds as a safe haven. And that's in 2008, for example, when the stock market crashed that year, bonds did great. They went up fantastic, and the United States were taught to invest a portion of our money in bonds as a safe haven to protect from financial troubles and stock market drops. And 2008's example of how it helps you. If you had half your money in bonds, or the TLT ETF, which tracks the 20-year Treasury bond, you basically would have broke even if you had half your money in that and half your money in the stock market. While most people, really suffered who had all their money in the stock market. But the problem is, if bonds are in a bear market now, they won't provide that safe haven function for investors. And that has huge ramifications for people listening, more so than, you turn on the TV tonight on CNBC, you're going to get stock picks or what's the market going to do next week. I'm talking about something that is really going to impact the markets for decades, and very few people are adjusting to or adapting to right now. And if you're early to adapt to a trend, you can really, really benefit. Well, how do you do that? Well, something is going to have to replace the safe haven mechanism for people's portfolios that bonds have done, and I would assert that what that something is going to be is gold. So I think people should own a portion of gold in their portfolios, 10% or 20% or whatever they feel comfortable with, and maybe even replace the portion they have in bonds with gold, or at least half of it. Because I think that's what's going to be the safe haven going forward. And so far this year, gold has done better than I've expected to do, even though, I believed it had gone into bull market last year. But the gold stocks in the entire stock market now are the number one sector year to date. That doesn't mean they're going to go up every single day, every single week. They got to go back up to their highs that they set last year before they'll break out of them, and really take off to the second leg of bull market that started last year. And I don't know when that takeoff is going to happen, but from an investment standpoint, looking from now, next couple of years, I really think gold and mining stocks is pretty much the best place for people to be.
We'll have more with Mike Swanson right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Mike Swanson. Mike, I've heard a comment that just because President Trump is pro-business doesn't mean the markets and the economy will flourish as well.
Well, it's a fascinating question or a thing to contemplate, because on one hand, the economy outside the U.S. stock market, which has gone up since Obama was elected years ago, has been very sluggish. And, yes, I know Wall Street profits have grown. Yes, lots of corporations have done share buybacks to then be able to announce on television their earnings are booming. But revenue has not been growing that much. The wages have been sluggish, and everyone knows that. And Trump has come in to try to change this by giving the small business person a lift by, talk of lowering the tax burden for corporations, which includes small business people that have S corporations, down from their personal income rate to, he proposed 15% in his book. Paul Ryan is talking like 20 or 25%. And also to ease regulations and Obamacare off of the small business person's back. But yeah, so I do think, he has ideas that can stimulate or grow the economy in ways that haven't been happening recently in the past couple of years. 2 years ago, or a year ago, even, I would read people like Paul Krugman and other, mainstream economists say that the U.S. economy can never again grow at 2%, ever, because of the debt burdens and so forth. And Trump, I think, is going to try to prove them wrong. He says he can make it grow 4%. If he accomplishes that, it will feel like an economic boom for a period of time. However, it's not going to be a stable situation because we still have all the problems that we're carrying over, not created by Obama, but they go back really from the 1970s and just grown with every administration, and that's the debt burden. And, you look at the stock market, and yes, the Dow's above 20,000 as you mentioned earlier, but, the valuations are crazy, So there's all kinds of potential potholes that could blow up, and then you throw in Trump's personality, and he, seems to want to create a little element of chaos in the United States and thrive off of that, to create controversies. Basically, the people who are political in the United States, they tend to fall into the two-party system, and if they're Republicans, they think of themselves as conservatives, and if they're Democrats, they think of themselves as liberals. And Trump is basically playing those sides off of each other. He will do something or say something that creates outrage among the liberals, and then the conservatives see the outrage and get outraged at the outrage and then support Trump. And really, the people outraged at Trump are kind of, they lost the election, and they're just kind of in pockets of the country, in New York City and D.C. and in California, in urban areas, and they're, not really thriving all over. That's why Trump won. So I think Trump thinks he's gaining in political influence and popularity with his own followers and the country as a whole by creating chaos and discord, even if, the mainstream television channels, or all the television channels for that matter, denounce him and get angry at him. I think there is a true method to what Trump is doing, and he's not simply, crazy or insane, but it's a strategy to dominate the political system. And until the Democrats figure out what he's doing and adapt to it, I think they're going to be in trouble winning elections. And I don't see any sign yet that they're going to do that. But with the economy, I do think his programs can create economic growth for a period of time. But at some point, the problems with the stock market and debt and the rising interest rates, even if they're going up slowly, at some point they're going to stop companies from wanting to do more share buybacks and borrow more money. And when that happens, the stock market's going to be in big trouble. Now, I don't see signs of that next week or next month, and it's just something that you kind of have to think of yourself as riding a train inside of a tunnel, and you just got into the tunnel with Trump's election, and everything seems fine. Everyone's drinking on the train. Everyone's getting nice, beefy steaks from the dining room brought to us. But at some point, we're going to come out of the other end of that tunnel and run into a wall. Yes, it's a nice train for now. Trump likes to build things, so let's just think he built this for us. But I don't know what's on the other end of that tunnel, and we've got to keep our eyes open and peeled. But I do know that the only real safe haven at this point, regardless of Trump and trying to predict, how the economy is going to do or exactly what's going to happen, is gold. So I'm happy to hold on to some gold and own it, and not just because I think it's a safe haven, but I think it's going to go up too. So that's how I'm positioning myself, and I'm just going to try to enjoy it.
What about the U.S. dollar?
Well, that's a good question too, and it's a good example of Trump, because when Trump won, I went and I looked at what his economic transition team, the different members of it, had said about the dollar. And several of them have said that we need a strong dollar. And Trump even made statements to the effect we need a strong dollar. Now, this past week, we've seen statements to the opposite, that the dollar is too high. Trump even himself said that a week ago. And then just a couple of days ago, Peter Navarro, who's one of Trump's economic advisors, said that the Japanese yen's up too much compared to the dollar. So you got crazy just contradictory statements made from 1 month to this week. And in the end, I don't really think that helps the dollar that much. It appears, if you take it together, that they want the dollar kind of locked around where it is trading at right now, not going up too much or down too much. And they're just going to, I would assume, if it goes up too much, they'll talk it down and vice versa. But in the end, I think this also is a supportive of buying commodities or gold or some sort of hard assets, because it's kind of a little bit chaotic, to think you're going to wake up the next day and what's Trump going to say about the dollar. It doesn't make me feel confident about the value of the dollar in regards to other currencies necessarily.
Well, don't higher interest rates naturally lead to a higher U.S. dollar?
Yes, they do. They do. But I think the key of what he's doing, and the Fed themselves, is to make rates go up slowly, not fast enough to make the dollar go up too much, or the economy slow down too much, or the stock market get in trouble. But I don't know, at what point you've risen rates too much. And really, if you go back to the 2000 bear market, the Fed tried to do that then too. They thought, well, we're just going to raise rates 3 times. When they raised rates 3 times, the whole stock market started to collapse. The internet bubble went bust, and in the fall of 2000, the whole economy slowed down. It was a total disaster. In fact, the Fed minutes of December 2000 show that Greenspan actually went into a total panic over the situation he had created with just 3 rate hikes. But we don't know, is 2 rate, well, we've already had 2. Is the next rate hike going to, cause everything to tip over? Or is it going to take 10? I have no way to predict that. And we are starting from, basically 0 of interest rates. So one could think we have a long ways to go. Really, my guess is things will probably be okay this year in the stock market, or at least into the fall. And you do need a period of transition that usually takes place between a bull market and a bear market, where you start to see a little bit of volatility, some sort of short-term, sharp, scary correction, and then a bounce back. And we haven't had a correction since last year in January, February. So until we have one, it's hard to start to see signs that things are starting to crack. It's more like, here we are in this funny situation, and just kind of enjoy it while you can. It's like that Bear Stearns guy said he had to dance while the music was playing in 2007 and sell his crazy mortgages and bankrupt his company. Well, we don't have to do that, but I think it just means we need to be patient before we get too negative on the stock market or too worried about it. But at the same time, you can't get too excited with the valuations where they are. That's why one of the main reasons I like gold so much is because it had already gone into a big bear market that ended last year, and we're just in the second year of a bull market, and we're not even in a giant, massive rally yet. The first year usually sees a big rally that's short-lived, and then you get a consolidation period, and that's really where we are. So we're in a good spot to buy and accumulate. The Dow's at 20,000. It's not that exciting to me to buy, but when gold's below 1,200, then people are scared of buying it. But when it's at the 1,200 area, people feel safe to buy it. And then when it gets to 1,300, they start to get excited. But the kind of buy isn't when everyone's excited. Buy ahead of that.
Mike, thank you so much for chatting with us.
Thank you. It's great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.